Okay. Good afternoon, everyone, and welcome to the third quarter Beacon Trust client webinar, the first ever using Zoom format. We're thankful for the great turnout for today's conversation, and we have plenty of meaningful content to share. 2020 has been quite a year. My name is Brian McGann, and I'm the head of investment strategy at Beacon Trust. Joining me today are my colleagues, Chief Investment Officer Dr. John Longo, who primarily guides our macroeconomic outlook, and Ermin Civilak, investment strategist who heads our asset allocation efforts and third-party manager due diligence. We're also very fortunate today to be joined by Liz-Ann Saunders, Senior Vice President and Chief Investment Strategist at Charles Schwab. Liz-Ann is a regular contributor to Schwab's publications, as well as a keynote speaker at many of their corporate events. She's also regularly seen on financial news networks such as CNBC and Bloomberg, and frequently quoted in publications including the Wall Street Journal, Barron's, and the New York Times. Liz-Ann, thanks for joining us. The format today we're going to follow, we'll start with John's comments focusing on our economic outlook. I'll then turn to Liz-Ann for her perspectives on the financial markets. Ermin's going to address some implications around the upcoming presidential and congressional elections, and we'll finish up with some Q&A. Thank you in advance for everyone who submitted questions prior to the call. Before I turn the presentation over to John, I just wanted to go through some logistics. Each participant is on listen-only mode for the duration of the call. Today's slides have been sent via email to all who registered, and if questions arise during the call, please feel free to enter those in the Q&A tab underneath the screen. We're recording today's call, which we'll post on our Beacon Trust website under the Insight section. That's it for my opening remarks, so I'm going to pass the presentation over to John.
Thanks, Brian. Thanks, everybody, for joining us. We're really gratified by the strong turnout, and it's really an honor to be speaking with Liz. We're all fans of her here at Beacon. Now, if you dialed into the call, I kind of know what you're worried about. You're worried about days like September 3rd, where you can see here. The S&P was down about 5% in a single day, and many of the stocks that have been leading the rally, so-called FANG stocks or stay-at-home stocks, were hit even harder. One of the major takeaways we want you to take from this presentation is to have a proper perspective. For clients at Beacon, we think that's a long-term perspective. Even if I look at year-to-date performance, the picture is completely flipped. We see, as I mentioned, some of the stay-at-home stocks, the technology stocks doing quite well, and even others such as Walmart, Procter & Gamble. So one theme that we'll keep coming back to, it's not really a stock market, it's a market of stocks. And we think there's always opportunities, especially if you keep a long-term perspective. Now, volatility is par for the course in equity investing. How we try to mitigate the volatility is by having a diversified portfolio. When the whole COVID pandemic hit, one of our first responses in terms of our communication is have 6 to 12 months of cash in a emergency type fund that would give you peace of mind. So what we can see here on the screen is that volatility goes hand in hand with equities. There is always a drawdown. Now the drawdown in March and April was kind of harrowing at 34%, but there's always a drawdown. And yet 3 out of 4 times, or 75% of the time, the market winds up in positive territory. As of last month, the S&P was up surprisingly 8% year to date. We've had a little bit of a pullback, and as of our call this afternoon, it's up around 3%. So just be aware that equity and volatility go hand in hand. Now, I think part of the reason we're having volatility is, of course, we have a very contentious election coming up. And as Brian mentioned, my colleague Ermin is going to drill down and give you some details on what historically happens. But the point I want to make from a macro perspective is that it's often the case, like we see in 2008, that about 30 or 40 days before the election and about a month afterward, volatility is heightened. And we can see why. People don't want to take risks. There's a lot of policy positions that are uncertain. And it just probably makes sense to just wait it out and then kind of place your bets, so to speak, after the dust settles. So just be aware that we expect continued volatility through the election. You can handle this volatility by, once again, having a diversified portfolio. Or if you have new cash coming into the market, my advice would be you can wait till after the election, or you can dollar cost average in that cash over a couple of months or so. Now let's shift gears a little bit and talk about what's happening with the economy. We think the recession is over, but it's going to take a while to recover where we were in January of this year. You've probably heard the term, and I'll mention this a couple of times in my remarks, the kind of swoosh shape, the Nike swoosh shape recovery. So this graph shows, it's a survey from specifically the Institute for Supply Chain Management, and they do a survey of people or firms in the manufacturing industry. And how you interpret the graph or the numbers is that if the number is higher than 50, it signifies expansion. If the number is less than 50, as we see here in April and May, it signifies contraction. So the good news is that despite this very severe downturn we've had, it looks like the economy will continue to expand, even though it may take a couple of years to recover the full amount of GDP. I'll show you some other graphs that will give a similar story. So services is also obviously a big part of the economy. Same group, ISM, they survey people, buyers, purchasing managers, and say, what do you see in your pipeline? Services, of course, could include financial services, healthcare, education, the two large segments of the economy. And we see pretty much the exact same picture. We see the economy dropping off the cliff in March, April, May or so, and then rebounding pretty strongly. We think the recovery will continue because of a number of measures, fiscal stimulus, the Fed, and other things that we can chat about, perhaps in more detail in the Q&A. Yet another indicator widely followed by economists is LEI, stands for Leading Economic Indicators, and it's a basket of 10 different indicators, things like the jobless rate, average hours worked, even things like the S&P 500, which, as you know, the stock market tends to kind of move ahead. And you can look at the inset of the graph here. Once again, we get a very similar picture. The economy falls off the cliff, it starts to recover, but as I said, it might take us a couple of years to get back to where we were in, let's call it January or February. But all signs point to the fact that the recession is likely over and that things are getting better. Now, the prior charts that I showed, they come out on a monthly basis. So if you're interested in closer to real-time information, the New York Fed comes out with their weekly economic index. And this is kind of where we can see that Nike swoosh shape. So the blue graph here is that weekly economic index. We kind of see the Nike swoosh shape that we're not quite to where we were in January. The red line is where GDP is. We'd expect that number to rebound pretty sharply, but take a couple of quarters to get back to January. And then the yellow line is a moving average. Those that follow kind of financial markets know that a moving average can kind of smooth out erratic or jagged data. But all the indicators I've looked at thus far show a recovery in the economy. Let's talk a little bit about equity valuations. Now, they are expensive. All right, so first of all, let's talk about the specific metric, price to earnings ratio. There are many earnings metrics, as you can see in this valuation box at the top, and I would kind of take this with a grain of salt. So just to give you some basic math 101, how the price to earnings ratio is measured, you take the current price of the market, the S&P or other index, and you divide that by earnings. In this case, we're looking at earnings 1 year ahead. Now, the problem with relying on a single data point is that in a recession or near the end of a recession like we are now, the earnings can disappear. So you probably remember from high school algebra that if you divide by 0, the number gets almost infinite. So we tend to look at what we call normalized earnings, earnings over a 3 to 5 year time period. On that basis, the market is a little bit expensive, primarily driven by those stay-at-home and technology stocks. So we're not terribly afraid of the market. If this was the early, late 1990s, like the internet bubble, I would be fairly aggressive and say, I think we should significantly reduce our equity allocations. But I'm not in this camp for a number of reasons. Number one, how the PE is constructed. But two, very importantly, the Fed came out last week and said that interest rates are expected to be 0 through 2023. So that's a really long time. And we think a lot of that cash is going to make its way into the equity market. Let me drill down that a little bit further. As I've said before, it's not a stock market, but a market of stocks. We see pockets of value even with the elevated PE ratio. Specifically, I think there's some good value in the healthcare stocks. If you have a longer term outlook, I think financials are well positioned. I know they're having some problems, but they came into this recession with pretty strong capital ratios. And just to put a plug for some of our specific equity holdings, in some of our strategies, we have the telephone stocks, Verizon, which is giving you an attractive 4+% yield, and AT&T, which is yielding even higher, although it has a higher debt load. So bottom line, even if the market itself is kind of flattish, we see some pockets of value. So let me kind of summarize the two things that I've talked about, as well as touch upon the risks, and then I'll hand it back to Brian and Liz. With the economy, we think the recession is over, that we are recovering, but it's not going to be a V-shaped recovery. You may have heard of the K-shaped recovery. K-shape is that people at the top of the income spectrum are doing pretty well, mainly because the stock market's recovered, but those at the lower end of the spectrum are hurting. So we wouldn't disagree with that view. I think the Nike swoosh shape recovery is probably most likely what's happening. I think the data point to that. So we think it's going to be about 2 years or so till we get back to where we were in January. And the main reason is the consumer. The unemployment rate keeps dropping from 10% to 8 or 9% or so currently, and the consumer is 70% of US GDP. And they're emotionally scarred by this experience. They're not going to go out spending like crazy until they have confidence in their job and the economy. In addition, we have had massive federal stimulus. We can chat about the additional stimulus that's kind of hung up, but we can't keep running these massive deficits, and the G part of the GDP equation, government spending, will likely have to taper off at some point, let's say looking out to 2021. In terms of our view on stocks, short term, and by that I mean probably through the election, we're kind of cautious on stocks. As I said, if you're coming in with a pile of cash, either just wait it out through the election or dollar cost average in. But over any long period of time, which we're defining 2-3 years or more, we like equities over fixed income. And number one, they're pockets of value. Number two, the economy, we think we're going to recover. And number three, importantly, the Fed is having interest rates at 0, not through 2022, but likely through 2023. You've probably read some articles about $5 trillion in cash on the sideline. And all of that, of course, is not going to make its way into the equity markets, but even a third or half of that can really move the needle on equities. In terms of risks, and there's always risk to markets, you've probably heard that expression, climbing a wall of worry. One, of course, is the path of COVID. Our baseline case is that at least one vaccine will be approved by the end of the year, but it's going to take a while to get that disseminated. I'm sure if you read some of the articles, you've probably read that there's a triage of how the vaccines will be disseminated. Specifically, the healthcare workers, those on the front line, will probably get it first, and then those with pre-existing conditions and the elderly. So our baseline case, it's probably going to be the spring till everyone who wants a vaccine can have it. And that's when I think we're going to see the economy getting back to normal, eating in a restaurant, going to a movie theater, and hopefully schools back to normal. So COVID-19 obviously is the huge risk. We're kind of optimistic on the path of that, but as Yogi Berra said, it's not over till it's over. We're also concerned about China and US relations. You've heard a lot of the contentious kind of saber rattling. We've seen the deal with TikTok and Oracle kind of up in the air. And I would expect that to get worse before it gets better. And there's tremendous policy uncertainty related to the November elections. Erman's going to drill down on that in detail, but let me just give you one kind of common example. If Joe Biden wins, I think that'd be a strong positive for clean energy stocks. Conversely, if President Trump is reelected, I think conventional energy, oil, gas, coal, it'd be better under a Trump administration for those stocks. So a lot of investors are going to say, I'm not going to place any bets until I have more certainty. And these are some of the things that we're worried about. So let me hand it back to Brian, and I'll look forward to hearing Liz Ann's comments.
Thanks, John. So, I hope you get the impression that we still are constructive both on the economic recovery front and for the investing front. Now, so we're now joined here by Liz Ann, and again, once again, thank you for joining us.
My pleasure.
So I would just open it up and ask, would you give us some of your perspectives on the market so far? It's been quite a year, quite a year of, fastest and firsts and so forth. So, I'll leave the open end up at that point right
Sure.
there.
You're right. It's been remarkable for a lot of reasons. And I think you touched on a key one that ties into a number of facets of this. It's the speed of this entire cycle. We've basically gone through sort of a full economic cycle and a full market cycle in such a condensed period of time. And that was driven by a number of factors. Of course, one is just the nature of a pandemic, and then the decision to shut down an economy means the speed with which you go into a recession is unlike anything we have seen before. It was just a screeching halt versus your traditional recession. And then the speed and magnitude of what was put forth by the combination of the monetary authorities and the fiscal authorities, not just in the United States, but globally, and combining those two within the United States on the monetary side with what the Fed did, on the fiscal side with what Congress did. At that peak, it was about 40 some odd, early 40% of GDP, which is unlike anything we have seen before. It caused a 25% surge in money supply, and that really represented the launch point for the stock market. I think what's also been unique is what has happened in the stock market is oftentimes seen as a disconnect between what's going on in the economy. And you touched on it. The reality, though, is looking under the hood of market behavior. There's been a lot of focus on the narrowness in the market, the dominance in performance of the big five names, which at their recent peak, of course, 5 only represents 1% of the S&P in equal weighted terms, but almost their own quartile, so 24% of the S&P from a cap weighted perspective. But think about that. Their weight is sufficient enough to have brought the average, the index, up to an all-time high as recently as September 2nd. But the reality is that the other 495 stocks on a year-to-date basis are actually in negative territory. That is a sign of this narrowness, but may also be reflective of an economy that so far anyway is rewarding a small subset of winners in an environment where there's still a lot of beleaguered industries and companies. I also think the speed worked its way into the psyche of investors. Part of the reason why I think the market was able to rebound is bear markets work their way into the psyche of investors, into the feelings and emotions of despair through not just price. We had that in droves at down 34% in the case of the S&P, but also through time. It's much more painful to have a bear market occur over, say, an 18-month period of time like the financial crisis versus just a few weeks. So I think that speed with which the market rebounded helped sort of reignite some animal spirits on the part of investors because there wasn't that time wait on the psyche of investors. And I think that may be one of the most important differences this time that doesn't get discussed as much as I think it should.
Yeah, I mean, this crisis was a lot different than, let's say, because it was a healthcare crisis, and so forget about what the market was doing. You were scared for your own,
That's right,
your own self. So you've also written a little bit about some of the dynamics of kind of a resurgence of a retail presence, especially in, trading and options and so forth. Did that have much of an effect for the narrowness of the market?
I think it's had a significant impact. It's hard to precisely quantify the impact of call it these newly minted day traders. And there's been some attempt. One of the largest companies in a process called payment for order flow. So when all these small trades, even though it's zero commissions, have to flow through these trading firms. And the biggest one is Citadel. And they came out recently and very publicly said they felt that retail trading by that cohort through apps and the likes of the Schwabs of the world represented at least 20% of daily volume. And that's significant relative to what has been the case in the last couple of cycles. But there's the feeder effect too. So there's been a lot of activity in the options market. A lot of these smaller traders are buying small lots of call options. That's a bullish bet on the market. And they're doing it in a way that's called unpaired. So they're just simply speculating in the options market. They're not hedging against the ownership of this underlying stock. Well, what happens when those speculators are buying that call option, a market maker who's selling that call option has to buy the stock. They actually have to hedge their position. So it forces these big market makers to buy the stocks that the little guys, so to speak, are speculating on in the options market. So that has brought in institutional players that has added to the momentum on the upside. So it's a bit of a chicken and the egg in terms of where you consider the start point. Plus, a lot of other institutions are benchmarked against the S&P 500, and they're under performance pressure. And if you are trying to beat the S&P 500 as an institutional manager, you can't do it unless you own those stocks.
Right.
So it's a sort of a collective force that drove momentum. But of course, as we've seen, it can also work in the opposite direction.
Right. Now, we've had a couple of instances this year. I remember late in May going into early June, and the same thing for the first part of September here. We've seen a little bit of a broadening of the market. So we had, industrials and the more cyclical industrials, materials starting to perform a little bit better at the expense of some of the tech names and so forth. Now with what's happening over in Europe with a spike in cases and a potential second wave, and it looks like, we may get a little bit of that stay-at-home technology stock driven market. I mean, but overall, would you agree that a broadening of the market would be a signal for a healthier economic recovery?
I do. I think it would be an important signal. And we've seen, as you mentioned, fits and starts of it. The problem has been that the macroeconomic data has not been strong enough in the immediate aftermath of these rotations to more classic cyclicals to support that rotation. So there have been these sort of attempts to move into areas that have underperformed. And then whether it's something on the virus front, you mentioned the resurgence in cases in Europe, concerns about now that we're sort of back to school, are we going to start to see it here too? In that case, that has been the factor. I think another factor driving the move back, at least near term, toward those stay-at-home type stocks is the combination of political uncertainty. Trade uncertainty is certainly a part of that. And I just think we're going to be in that fits and starts environment until we have a more sustainable upward trajectory in the economic data, which again has just been in fits and starts.
Yeah, and that seems to, fit into what our theme has been is really stay the course. There's no way to justify trying to time or trade around as long as you own, and John mentioned before, well-diversified portfolios. You're catching a little bit of everything that's going on without having to get in at the exact time. Another thing that I know that may be on your concern list is what's been going on in Washington and the effects really of the consumer with the unemployment situation and the kind of the cutoff in the extra benefits that people were getting. So, about the reopenings of the economy. I mean, there's a segment of the population that seems to still be kind of in limbo with, with their job or anything. So as that wanes off, how long before that really affects the consumer?
I think it is a very important factor, and I think could be another key reason why the shift toward a more cyclical recovery stalled is concern about getting a fiscal relief package or the next fiscal relief package passed. And I think with the passing of Ruth Bader Ginsburg and Congress's attention more on the Supreme Court, it sort of diverted attention from the stimulus package. And I think that's a big factor. One statistic that I think really is the potential tell of the impact of not getting something is during the span of time where we were, those that had been recently unemployed were receiving those supplemental unemployment insurance benefits, the $600 a week on top of whatever their state provided benefit was. Of course, that came following the receipt of the stimulus checks that were sent directly to households. So during that span of time, if you broke consumers into two cohorts, the recently unemployed that were receiving that enhanced unemployment, and then the still employed, obviously, who, although might have received stimulus checks, were clearly not receiving any kind of unemployment insurance. During the stimulus, the unemployed cohorts dropped their spending much more significantly than the employed cohort. That shouldn't come as a surprise to anybody. But during that span of time where we had those supplemental benefits, the unemployed receiving those benefits cohort took their spending back up to pre-stimulus levels, where the employed cohort did not and still has not come back to that pre-pandemic level. So that suggests that there was a lot of consumption fueled by those enhanced unemployment benefits. Now, the savings rate is high. It's elevated at about 18%. And those more on the economic bullish side of the camp will say, we don't have anything to worry about, even absent that, the savings rate is sufficient to keep consumption. But even if that's the case, it still goes to the psychology. I just think that if we continue to be an environment of uncertainty, we don't get that stimulus, we start to see made a bit of a leveling off in job growth. We've seen a big move up in permanent job losses, even as temporary job losses have come down. The weighing on the psyche, not to mention virus related, could put a damper on consumption, even with that elevated savings rate. There might be the attitude, you know what, this needs to be a rainy day fund. And so I don't think that is getting addressed enough.
Yeah, and I think that goes to, your earlier comment about the speed and how that was a help back in, the late March, early April time in turning around the economy. I don't think any of us thought at that time that we'd still be sitting here in, near the end of September, still primarily working from home or remote and having, New York City with restaurants not open. I thought we were probably in the camp of a 2 to 3 month, shut down and then kind of the resumption of back to normal. Certainly by September, kids were all back in school, everybody was back to work. So the duration is really lengthened out, which,
Sure
to your point, is now going to weigh
Yeah.
on the psyche. So,
That's right.
John had made I thought an important point earlier on to keep things in perspective, right? We had a fantastic return year in 2019. 2020 is turning out to be, if we ended here, it'd be okay. You'd forget what happened all throughout the year, but it'd be okay. So these rolling 12-month periods have still been relatively good. So, I think the dynamics have changed. And just we're getting in a lot of questions about different sectors and industries and so forth. So I'll just, try to ask, from a risk standpoint, outside of the global pandemic, elections, and everything else that we're worried about, is there anything else that, that's on your mind that causes a bit of a concern here? And I mean, there's so much being thrown at everyone, the political situation, everything.
So I think, you talked a bit earlier about valuation, and I agree it's in the eye of the beholder and a function of what metric you choose. And I think with zero interest rate policy, as far as the eye can see, certainly from an equity risk premium perspective, it suggests the market is not terribly expensive. And even on traditional PE, if you're discounting those future cash flows at basically zero, that supports a higher than average valuation. But the reality is that we think of valuation as a fundamental indicator, where the reality is that it's as much a sentiment indicator as anything else. It's there's quantifiable components, but there are times where investors are willing to pay nosebleed valuations for stocks. You could argue that's been the case recently. It was certainly the case in the late 1990s. And then there are times where investors don't want to pay anything. I think, though, when you get to an elevated level like this, there's one of the risks, I think, is investors are going way too far into the future to find that boost in earnings sufficient to justify current valuations. And even if we're looking in a year out, at some point, I think earnings are going to actually have to perform not just better than expectations, but actually get back into growth mode. On the other side, I've got sort of some good news. Don't want this to all be fairly negative. We talked about the speculative excess being seen in by certain cohorts, the newly minted day traders in the options market. But very much unlike the late 90s into 2000, we don't have pervasive optimistic sentiment. This is not an era of euphoria across the spectrum of sentiment indicators. A lot of attitudinal measures of sentiment, survey data shows a much more subdued picture. So that's the good news, that speculative excess is somewhat limited, not only to a particular cohort in the market, but to particular parts of the market, not across the board.
Fantastic. Well, I think, again, just the final comparison now with our top 5 in the S&P relative to what was driving the S&P, the top 5 tech names in 1999 and 2000. We actually have business models that are proven and work today in some of in those names, as opposed to
not only that,
when.
the top 5 names in 2000, which there was only one overlap, Microsoft, but ExxonMobil was actually one of them in 2000, and so was GE. But the average PE of the top 5 stocks back then in 2000 was 60. It's 33 today. Right. So that chasm between the top 5 and the bottom 495 from a PE perspective was way wider back in 2000, even if we have a larger weight represented by those names in the index today. And that is testament to your point of much stronger underlying fundamentals of the companies today versus then.
Right. We can't live without our Apple phone.
Well, you think about, not that I'm endorsing any of the 5 names, but all you have to do is think about how much time, especially in pandemic mode, that we are living and working and operating in the ecosystem of those companies.
Right. And I think you had made a point in one of your recent, the top names actually span a few different sectors now.
Right, three actually. So you've got Apple and Microsoft are the only 2 tech stocks. Amazon is consumer discretionary, and it's pretty dominant in that sector. And then Facebook and Google are communication services. So they're lowercase t in quotes. Tech.
Right.
Techie.
Right. Yeah, that's right. Thank you for those comments, Liz Ann. Can you hang on for
of course.
a few more minutes? We'll
Sure,
get to some questions.
Absolutely.
But I wanted to turn to Ermin, because this is particularly on a lot of people's minds with the upcoming election, and so already contentious and split, and so we're getting a lot of questions, as I'm sure you do all the time as well. What do we do with the portfolio if we get a change in the White House and so forth? So I'm going to ask Ermin to run through a little bit of the implications and some of the historical precedents around that. So Ermin, if you wouldn't mind. You're on mute.
And today is National Voter Registration Day, so it's only more appropriate to talk about elections and investment implications. So yeah, we're saving the most contentious topic for the last discussion. So I'm going to share my screen and start talking about some of the investment implications of elections. But before I do that, I want to just discuss risk versus volatility. A lot of investors see elections as a risk factor. I see it as a volatility factor, and it is quite typical to see bouts of volatility around the election day, month before to a month after. So it is normal for the stock prices to gyrate, and volatility is defined as up and down movement in stock prices, unlike risk, which implies sort of a permanent loss of value or impairment of capital, such as it will be the case with a bankruptcy, for example. So while we see the volatility impacting elections, we don't necessarily see it as a major risk factor leading to permanent losses. In terms of calling the results, it's really hard to handicap the outcome of the November elections or structure a portfolio purely based on who's likely to win the White House or the Congress. Not only the polls are too close, especially in the battleground states where they're within margin of error in most of them, but also a lot of what gets implemented under the Trump or Biden administration is going to depend on whether Republicans keep the Senate or not, and whether Democrats keep the House or not. So it's generally not a prudent exercise to make grand or sweeping changes in a diversified portfolio ahead of binary events such as an election. But based on history and based on logic, markets generally like a divided Congress over a unified Congress because there's checks and balances, oversight against one party having too much sway. Therefore, if a single party sweeps the elections, and we're getting a lot of questions on a blue sweep, which I'll get into in a few minutes, but if a single party wins the race for the White House and both chambers of the Congress, it's likely to lead to an initial sell-off. But once the uncertainty on the new government is eliminated, markets tend to do well under both Democratic and Republican presidents. And one reason for that is most measures in the Senate, the upper chamber, needs a supermajority of 60 votes to end the debate, which neither party will likely to have unless they change the rules. But that is hard to overcome. And it only takes a few moderate lawmakers to cross the aisle to the other side to kill a proposal. So even one party having control over three parts of the government doesn't necessarily mean that the stock market is going to crash. But in general, the perception is that Democratic presidents are perceived to be less friendly to Wall Street and to business. But that's just a perception. The historical results do not fully support that theory and show that the stock market does just as well under a Democratic president, in fact, perform better in certain periods, depending on the period used for the study. And I'm going to show you one in a second. When a Republican president is in the White House, the markets generally do well early in the 4-year cycle. But if you look at it over a full-year cycle, there's no statistically significant difference between Democrats and Republicans. And when you take the composition of the Congress into account, the scenario that produces the highest annualized returns for the stock market is a Democrat president with a split Congress, which as of today, if you look at the odds, is one of the higher likelihood scenarios. But a lot could change obviously between now and November. Here on this page, you kind of see the 6 scenarios, and you can see that a split Congress generally leads to higher results. And the one that again has the highest annualized return is a Democratic president with a split Congress. But one footnote that I'd like to add is some studies take out the late 90s, sort of from 95 to 2000, when S&P 500 was annualizing at 25 to 30% per year, which was aberrational. We talked about how unsustainable the multiples were back then, and a Democrat was in charge in the late 90s, Bill Clinton. So when you take that period out of this study, the bar charts that you see are pretty even. So it really doesn't matter who is in the White House when you make that adjustment. This study doesn't adjust for that. It shows you a complete history. And this is a historical analysis of what happens if there's a blue sweep, which means that Biden wins and Democrats win the Senate and they keep the House. Based on the most recent 5 episodes of a blue sweep, yes, there'll likely be volatility, a sell-off in the fall. But if you look ahead 12 months after a blue sweep, the results are quite in line with historical averages for the stock markets. There's really not too much to fear, except perhaps some volatility until the market adjusts for that new normal. So now I'd like to turn into the fiscal policy discussion, and we're getting a lot of questions. So kind of getting into Q&A. One question was, can you expand and explain the Biden tax plan, the new and costly social plans, and what that means for the outlook, and whether one candidate is better for the stock market and the overall economy than the other. Biden's big proposal is, his flagship proposal is this green infrastructure deal, which calls for $2 trillion of spending in things like clean energy, electric cars, batteries, fuel efficiency standards, energy efficient homes and offices, spending of $2 trillion over a 4-year period. And it would obviously boost those industries at the expense of the traditional oil, natural gas, fracking, and some of the energy infrastructure industries. He also proposed spending up to $780 billion on childcare and elderly care over a decade. That includes universal pre-K through tax credits, where families would get 50% of the childcare costs reimbursed if they make less than $125,000 as a family a year or less, and it kind of phases out after that. Families making from 125 to 400 get a partial credit. Biden's plan would also expand the care coverage for elderly and disabled, in part by increased Medicaid funding to the states. Now, in order to fund and pay for these massive initiatives, as well as the fiscal response to COVID-19 crisis, it's almost a certainty that the taxes will go up under the Biden administration. For corporate taxes, that means increasing the corporate tax rate, which today stands at 21% to 28%, which is at the midpoint of where it was before the Trump tax cut and where it is today. So an increase from 21 to 28. And on the individual tax front for high income earners, meaning families making 400,000 or more, increasing the marginal, the top tax bracket from 37%, which is where it is today, back up to 39.6%, which is where it was a couple of years ago. It may not be imminent, it may not be as much, but that's what's talked about, that's what's discussed today. Those changes would obviously have some trickle-down effects. Stock market could very well be lower with less stock buybacks and lower earnings per share amounts. But eventually, as I said, businesses and individuals get used to the new normal and can plan for it. So it's not high taxes or low taxes that the stock market doesn't like, it's the uncertainty that the stock market doesn't like. So it's important to remember that. But as I said a minute ago, the reality is that even if Trump is reelected, taxes will need to go up, along with perhaps some more efficient government spending in order to pay for the cost of the financial response to COVID-19. But again, doesn't mean that the stock market will crash. To provide, again, some historical perspective on tax increases in the past, 12 months after corporate taxes go up in the United States, S&P 500 is up 13% on average, reflecting a healthy economy and a strong market. So higher taxes doesn't necessarily mean a stock market crash. In fact, the history shows quite the opposite. And there's also some talk about capital gain taxes. If long-term capital gain taxes are taxed as ordinary income on high earners, again, families making 400,000 or more, as opposed to the lower preferential rates, as well as the step up in basis being eliminated, which is no taxes being due upon death, as opposed to paying taxes upon death, those could have negative implications for people in the highest tax brackets and require additional wealth planning. It's very much anticipated that it can lead to a spike in significantly appreciated assets from being liquidated and sold. But the stock market as a whole, I think, will be fine, because most of the stock market, at least in the United States, is owned by institutions such as pension funds and retirement accounts. About 75% of stocks in S&P 500 are owned not by individuals, but by institutions. So I think the stock market as a whole will be fine. Social security taxes, which I don't have on this page, but security taxes will also go up for some people. But it's important to remember that these are structural changes that are not so easy to implement, especially with a likely divided Congress and a Senate with roughly equal number of Democrats and Republicans. So that's enough on taxes. On international trade, there could be some policy differences. I think Biden would be also tough on China, maybe not as tough as Trump, but will be tough on China. And if he gets elected, he may ease some of the tariffs on China. That would actually clear some of the headwinds that the stock market faced before the pandemic and help some of the large US multinational firms. That would actually be a positive for the stock market. On the manufacturing front, Biden's proposals are not all that different than what Trump has been implementing over the past few years, which is to bring manufacturing back to US soil. In the case of Biden's proposal, that's through some offshore tax penalty on profits on manufactured goods and services if they're produced overseas and reimported back into US, covering not only things like iPhones, which we discussed, shoes and t-shirts, but also accounting services and call centers. He also would add a 10% Made in America tax credit on a broad range of investments designed to create manufacturing jobs in US. So we may have a status quo. And I don't think Biden's gonna promote legislation that's gonna kill economic recovery and kill jobs growth. Now, there'll be likely winners and losers, and we've discussed some of them in the energy space, but specifically on tech and healthcare, which has been driving the economy and the stock market higher, the big 5 tech companies, Apple, Amazon, Facebook, Google, Microsoft, they could see their market dominance come to an end because of higher taxes and higher regulation. Those companies today pay some of the lowest effective tax rates. So if tax rates move higher, they will be the most affected, as well as the cost of higher regulation. On healthcare, if a national healthcare plan gets implemented, the 3 broad markets or industries of the healthcare sector, hospitals, insurers, and drug manufacturers, would be impacted differently depending on how it's designed. If the federal government negotiates lower prescription drug prices, for example, that would probably hurt pharmaceuticals and dent their profits. But hospitals and insurers could actually benefit from an expanded healthcare coverage, although yesterday we saw those stocks sell off significantly because Supreme Court, as some of you may know, is going to consider ACA, the Affordable Care Act, also known as Obamacare, a week after the election, and there's a chance that it may get repealed. So hospitals and insurers could actually be hurt by that. In the financial sector, bank stocks, we got a question on this too. What's the outlook for banks? Why are they lagging so much? In a zero interest rate environment where the interest rate curve is flat, they don't make as much money and there's rise in delinquencies. So they haven't performed nearly as well as some of the other growth sectors. But if someone like Elizabeth Warren is named the Treasury Secretary, it would certainly imply higher regulation and higher regulatory costs for banks, and it could make it worse for the large banks. Now, I talked a lot about Biden because investors can better predict what Trump policies will be in his second term if he's reelected. Reduced regulation, lower taxes, domestic manufacturing, a push for a level playing field on international trade. These are all pro-growth policies that the stock market likes and has high power of predictability. Hence, I don't think the stock market will experience high volatility if Trump is reelected. That being said, there is a caveat. He does not, or he would not face a reelection risk in 2024. So he can go off the reservation on some issues, which could create some unexpected volatility of its own. So in summary, and talking about our specific portfolios that we manage for our clients, we we feel fairly confident that the Beacon portfolios will continue to perform well relative to their benchmarks, relative to their objectives over the long run, regardless of who's in the White House next year. There'll be policy differences, there'll be sectors that perform better than others, but the market generally shrugs off the color of the party that's represented in the White House. It's not going to break the nation. There are factors that are more relevant, like corporate innovation, monetary policy, the Federal Reserve, consumer behavior, demographic trends. These actually matter more than who's in the White House. But most importantly, our portfolios are really designed to be diversified, diversifying the risks, buffering the downside, avoiding concentrated bets, and using an adaptive, active asset management process where we make shifts and adjustments to take advantage of the risk return expectations. But one thing we don't do is make binary bets on elections or anything else that has a binary outcome, because we believe that that's not the best path to intelligent portfolio management. And lastly, history has shown us time and time again that taking that long-term perspective has always rewarded investors, which is something that we preach every day and something that we practice every day. So we'll now turn over to questions, and I'll hand it back to Brian.
Well, thanks. And I think the takeaway at this point in time, meaning September 22nd until the actual election, is that we have two candidates that are campaigning very hard. So proposals come out, and so let's wait and see what the results are, and then evaluate the proposals and plans, and see what becomes viable options. So be prepared for probably the best reality TV show that's been on in a long time for the next couple weeks, because of just the nature of the campaigning. So but thanks. So a lot of questions did come in regarding the markets and so forth. And I know we talked a lot about the S&P and the top tech names. So Lizanne, any opinion, in the lagging small cap sector overall over the next 12 to 18 months?
So I think small caps represent some similar characteristics as some of those classically value sectors, be it materials, industrials, even financials. And there's weights within the small cap that tie those together. The problem right now is that the fundamentals for small caps in the aggregate, particularly if you're using Russell 2000 as the benchmark, are still inferior to the large caps. And it's across the metrics that I think will continue to be factors that will define leadership. And they're not at the sector level. It's not really even at the cap level, but it's quality-based factors. So strength of the balance sheet, positive free cash flow, strength of management team, debt to equity ratios, and small caps, again, in the aggregate, have much weaker profiles on those metrics. Higher debt to equity than the larger cap brethren. In the case of the S&P 500, a much higher percent of so-called zombie companies that aren't earning enough money even to pay the interest on their debt, let alone funding their operations. Because profitability is actually weaker, valuations are actually higher. So they still have that fundamental hit against them. Now, it is the case historically that small caps do tend to find traction when you're sort of, for sure, out of the recession, you're picking up in that growth trajectory. And I think that could happen again this time. We just may not be yet at that inflection point. I think there's opportunities to sort of pick and choose within the universe, but I would absolutely have that sort of quality lens on your glasses when looking for small caps. I think that will be key to differentiate within that subset the winners from the losers. Yeah,
thanks. And John, one for you on the economy. There was a question coming in about when we see the economic situation improving materially as a result of an effective vaccine. So I know there's been a lot of talk about vaccine, and again, fits and starts with some of the healthcare companies on that vein. But again, let's take the scenario where the vaccine is approved and available by the end of the year. At what point does the economy materially improve from that point? And then the second part is, if we get a 6-month delay from that December timeframe, let's just put it in that context.
So to be clear, the economy can't get back to normal until we have an effective vaccine. Once it comes out, it's going to take a while for that to be disseminated. So if there was a 6-month delay, I think the market would react negatively, but ultimately would come to grips that there is a vaccine on the way. So not to get too much into the weeds, one way of valuing the market is the present value of the future cash flows. If the near-term cash flows were a little bit worse than expected, the market would trade off on that, but it wouldn't be overwhelming like we saw it, I think, in March and April. So vaccine means back to normal. Back to normal means the economy's back on track, and then we can get more of a cyclical recovery.
Okay, there's a specific question, Lizanne, for you here, addressed to you. What will the Awesome 8 do going forward?
Well, the Awesome 8 is the big 5 plus a few other names. I think NVIDIA, Tesla, and which one am I forgetting?
Netflix, are they in there?
Yes, Netflix, because Netflix isn't one of the big 5. I should have started by saying I don't cover any individual stocks at all. I do no bottom-up work. Even personally, there's only one stock I own personally. The symbol is SCHW. You can figure out what that is. And I'm partly compensated in that stock. So I'm probably the worst person to talk about it. But I talked about just in the aggregate, that narrowness of leadership. And I think we are already starting to see some cracks in that. There are relatively benign ways you can go through a rotation that corrects some of the excesses without taking the entire market down with it. You could, to some degree, argue that that's what we've been seeing, at least in the case of the top 5. I know at the worst point in the recent kind of rotation corrective phase, on average, those stocks were down around 17, 18%, so not quite into bear market territory. Enough to ease a little bit of that excess, again, without taking the entire market down with it. That's the benign scenario. I think we could see that. That would be a healthier way to correct some of those excesses than more and more upside momentum and speculation occurring in those names. Inevitably, you're going to hit some sort of inflection point. I think the pain in the aftermath of that would be more severe if the melt up in those names doesn't take a breather every once in a while. So I personally would like to see a continuation of some of these fits and starts and some of this rotation that eases some of that. As fun as it is to sort of ride these names into the stratosphere, melt ups tend to end in meltdowns.
Right. No, I agree with the broadening out would be healthier than not. To be respectful of time, one more question here, and this one I'll throw to Ermin. Outlook in this environment for gold and real estate, and I have you on the clock with 2 minutes at most.
So gold, we feel fairly optimistic on because of a couple of factors. Times of uncertainty generally results in higher gold prices. When real rates are low, as they are today, that results in positive outlook on gold. Weaker dollar leads to better gold. So we're fairly optimistic. It's a good portfolio diversifier, not correlated to stocks and bonds. On real estate, it depends on what type of real estate. When you look at the composition of the broad real estate markets, industrials sector is doing really well with e-commerce, storage, and apartments are doing okay, with work from home, but obviously retail and commercial is not. So it depends on what type of real estate you're looking at, and you got to be selective and weigh the risks against the returns. On the broader residential market, the numbers that are coming out both on volume and price are pretty solid. I think there's a trend towards bigger homes away from cities, which, may reverse at some point, but the current trend is for higher real estate prices on the residential side.
Okay. Well, we're bumping up to the hour. So Lizanne, I want to thank you once again
My
for
pleasure.
taking the time to spend with us and our clients.
Thank you.
Greatly appreciate it. So thank you. And John Ehrman, thanks for your input as well. As always, great job. To all the clients out there, thank you for taking the time out of your afternoon to listen to us here. And if anything comes up, please, always feel free to reach out to one of your teammates or here at Beacon. Thank you again. Enjoy the rest of what's left of this afternoon. And we'll see you soon. Thank you all.